Okay, folks, welcome back. This is price action model number 8, targeting 6% per month using a 25 pip per week model. All right, ICT price action model number 8, 25 pips per week trade plan, targeting 6% per month model. Like all of our previous presentations, we have to go through the 5 stages of trade plan development: preparation, opportunity discovery, trade planning, trade execution, and finally trade management. Okay, preparation: note all medium and high impact events for the markets that you're going to be following. Study the events on the week to come and consider how the current market structure and the calendar events may suggest a specific weekly profile for that week's range. Preparation: determine the IPTA data range for the last 20 trading days. We're only focusing on the last 20 trading days. We're not really concerned about 40 days or 60 days look back, just the last 20 trading days, and we do not use or count Sundays. Note the highest high and the lowest low in the past 20 trading days. This is your current dealing range. Inside this dealing range, we look for the next draw on liquidity. Where is price likely to trade to next? Below which old low or above which old high? We look for a PD array in the direction of the weekly range bias. Okay, preparation stage still. We anticipate price to move to a PD array that would support our weekly bias on a day and news release found on the economic calendar for the current or next trading week. This volatility injection is what we wait for. This would be a run based on a low resistance liquidity run conditions. Opportunity discovery. We look for 25 pip ranges that would enable a run to buy side liquidity when bullish institutional order flow is present, or target the sell side liquidity when bearish institutional order flow is present. Now if you look at this diagram to the left, it's a 15-minute time frame of the euro dollar. Now the little box that represents the 25 pip range, that's actually 25 pips relative to the current scale of this chart. If you're looking at price action, and we're going to assume that we're bullish for euro dollar, which we have been for the last couple weeks at the time of this recording in November of 2020. Your ideal scenario for this trade plan is to be looking for scenarios where, if you're bullish, you're going to be framing a run to and above an old high that offers that scale of 25 pips. So you're training your eye to look for these types of setups. Anything that would frame a price run that would give a 25 pip price delivery on the upside, when it's bullish, that's what you're framing. Trade planning. When the market is poised to decline, we want to look for a convergence of both manipulation and price opposite to our trade bias at a time the economic calendar suggests a volatility injection will likely unfold. We will short premium fair value gap or short buy stops in a stage 1 or 2 redistribution. When the market is poised to rally, we want to look for a convergence of both manipulation and price opposite to our trade bias at a time the economic calendar suggests a volatility injection will likely unfold. We will buy discount fair value gap or buy sell stops in stage 1 or 2 reaccumulation. Trade executions. When we are bearish, we will anticipate a 5-minute chart institutional order flow entry drill, trade entry, to form inside of a retracement higher during the London Open and or New York Open kill zones, or buy stop raid that we will go short when it unfolds. When we are bullish, we will anticipate a 5-minute chart institutional order flow entry drill, trade entry, to form inside of a retracement lower during London Open and or New York Open kill zones, or a sell stop raid that we will go long when it unfolds. Short trade management. When we are entering a short, we will place a sell limit order We will execute with our demo account. We will use the PD array convergence minus 5 pips as our entry price when using the sell limit order. Long trade management. When we are entering a long, we will place a buy limit order. We will execute with our demo account. We will use the PD array convergence plus 5 pips as our entry price when using the buy limit order. Short trade management. When we are entering a short, we will place a limit order to take 25 pips as our objective on a single position. We will use one order to manage the trade idea. If you capture a 25 pip objective, close the trade via limit order and wait for another opportunity. Long trade management. When we are entering a long, we will place a limit order to take 25 pips as our objective on a single position. We will use one order to manage the trade idea. If you capture a 25 pip objective, close trade via limit order and wait for another opportunity. Stop loss management. When we are in profit 50% of our expected objective, stop loss can be reduced by 25%. When we are in profit 75% of our expected objective, stop loss can be reduced by break even. Money management. Position size calculation formula. Position size equals account equity times R% divided by stop loss in pips. Position size is the amount of leverage your trades or trade assume. Account equity is the total amount in your trading account. R% is the percent of risk you are willing to take on per trade. The difference between the entry price and your stop loss is the number of pips you will use to divide the result of equity times R%. As an example, account equity of $20,000, risk per trade 1.5%, or 20,000 times 1.5% gives us $300. The stop for this model, we're going to be using 15 pips. Now this can obviously be scaled to whatever you want, but just in the way of mixing things up, because I've been using 20 pips up till now in all the models and trade plans. This model can use a 15 pip stop loss because you're working with a 5-minute chart. So the stop required for this trade equals 15 pips. So in micro lots, 1K each, or 10 cents per pip. Stop loss of 15 pips times 10 cents equals $1.50. So $300 divided by $1.50 equals 200 micro lots per trade, or 1.5% of the equity. We're always going to round down. Same scenario, but using mini lots now. Mini lots are 10K each of leverage, or $1 per pip. So 15 pip stop loss times $1 is 15 US dollars. $300, which is our total risk of 1.5% of 20,000 divided by $15 gives us 20 mini lots per trade, or 1.5% equity. Again, always round down. And finally, for standard lots, which is 100K leverage, each pip would be represented by a $10 fluctuation. So a 15 pip stop loss times $10 is $150. $300 divided by 150 gives us 2 standard lots per trade. If your demo account takes a loss on a trade and it is a full R% you assumed, drop the R% by 50%, and when the loss is recovered by 50%, you are permitted to return back to the maximum R% per trade. If the reduced R trade assumes a loss, reduce the R% by 50% until the previous trade loss is recovered by 50%. If you take a series of 5 winning trades in a row, drop your risk percent by 50%. You are likely to assume a loss eventually, and this will build in equity leveling and reduce the likelihood of a large drawdown. You want a smooth equity curve that slopes or stair steps higher, not jagged or with deep declines. Start backtesting. Collect multiple sample sets with this trade plan. If you're unclear about some of the process, rewatch the lessons for this particular price action model. I will provide sample sets, but do not rely or wait for mine. Dig into your charts and study what was provided here. Good luck.